Hello, everyone, and welcome back to the continuation of week 2. Now I'm talking about interest rate risk, which is part 2, as I promised you. Now, I already talked a little bit about interest rate risk, but now in this part, we'll talk about it in terms and in details, which means I want you please to take care of the modelings and how to measure that risk. We have two models, one model called the repricing model, the other one called the duration model. So we will go over them and we will go a little bit in deep for the interest rate risk. Now, if you allow me, please, I will share my screen, and this is around over 20 slides. Hopefully we'll just, okay. So this is part 2. And again, I will remind you with this, so we are talking today about this specific risk, interest rate risk, as part of our matrix risk, part of our matrix. So this is actually part 2. And let me start with the definition. We already defined it in part 1. Now we will define it a little bit here. So interest rate risk is the risk to earning and capital. And I want you to understand what do we mean by earning and capital. So this is a risk to the income statement, and this is to the balance sheet, which means one to the capital and one to the net interest income. Now, how does it affect the earnings, which means the income statement, the bottom line, the net income? When market interest rate, for example, when market interest rate changes, what do you think, how well this affects actually the bank's net interest income? Take this example. We have net interest income, which is actually the interest income plus the interest expenses. So the interest actually income is interest receivable in loans, and the interest expenses is the interest payable on deposits or payable on loans. Now, the changes in the interest rates can lead to change in the net interest income, which means if the interest if the assets and liabilities actually not matching, and there is an increase in the interest rates, so I will increase my loans rates and I will increase my liability loans. That's fine. And in this case, I will be earning because my assets will earn more interest than I have to pay to my liabilities. But if the case is different and my liabilities is higher than my assets, I will have to, and the interest rate is increased by 1%. Yes, I will get 1% more from my assets, but 1%, but I will have to pay 1% more to my liabilities. But actually, my liabilities is higher than my assets. End of the day, I'm paying more than what I'm getting. The net impact on the income statement, or what we call the net interest income, is actually will represent losses. And this is what we call it, the impact on the net interest income and the risk to the earnings. So our earnings will decrease. Now, the capital should be, the impact on the capital should be very straightforward. Why? Because when we have investment, as I explained to you, and the interest rate, if we have 100 million of bonds today and other securities that give me fixed income, and the interest rate increases, directly my assets will drop, because as I told you, the price of the asset is actually the cash flow over the income. So 1 plus I, which means, so this one actually, well, if this increase, if this is increases, as I said, now in this case, the price will go down. So if the I increases, as I explained to you before, the price will go down. And this is actually the impact of the increase in the interest income and in the capital, which means now, since my capital or equity is actually the difference between the market value of the assets and the market value of the liabilities, now the market value of the asset will drop, which means the market value of the liabilities will drop also, but if there is no matching, this will impact actually my net worth because of the increase in the interest income and the interest rate that will drop the market value of the assets and liabilities together. But if my assets is higher than my liabilities, I will end up losing in my equity. Okay, this is the whole thing. Now, let's go a little bit deep. Don't be, this is too much colors and all these things in this slide, but I meant it. I tried to make it like this. So just as easy as this. And this is very easy to explain. Assume I have a deposit. This is a liability, a deposit of 100 million. Fine. I receive it today. And today also, I gave a loan of 2 years from that deposit. And this is happening in banking. Now that is fine. As you can see, for the first year, I'm so happy because I'm receiving the deposit for 10% and receiving 12%, making 2% different out of the 2 million, which means I'm making 2 million. The problem is these people, the liability depositors, will come in year one and they want their money back. So there is two options here. Either I will ask them to increase it for 1 year, keep it for 1 year more, or I can get some other depositors, give me the 1 million, their 100 million, and I continue because their money is locked here. I can always get another deposits, or I can always rule over those deposits. Until now, everything is fine. The problem is, what if the interest rate increases? Now, when it increases, I cannot increase this one. It's fixed for 2 years. This is not a floating rate, it's a fixed rate. And it is, this is where the interest rate comes to the problem. The problem is when this is mature and they want to renew it, they will ask me for the new rate. Either the same depositor or any other depositor. We will have to have a new term and conditions, and we have to have a new contract. Now, assuming the next year will be 9%, this is here 10%, maybe the interest dropped to 9%, or maybe it stays, or maybe it goes to 11%. If I am here in 9%, I'm gaining actually, because I'm receiving now 3% for the second year. If I'm here 10%, then there is no problem because 10% and 10% still the same. The problem here, if I'm in case 3. If I'm in case 3, I'm exposed to interest rate risk, and this is coming from the refinancing. So it's interest rate risk coming from the refinancing, mean I'm looking for somebody to refinance. Now, let's look to the case from different perspective. The same 100 million, but this deposit man want to put it with me for 2 years. However, the business company wanted only for 1 year. Now, the second year, this guy will receive from me 10% fixed rate for 2 years. This guy, the borrower, will give me only 12% in first year. The second year, we will have to have a new term and conditions, which means the rate could be 11%. Now, 11% is a problem. Why? Because I used to have it 12%, now it's 11%, which means there will be 1% decrease in my net interest income. I still gaining, but there is 1% drop from this year to this year. Here also, maybe it's 12%, there is no difference, or maybe it is 13%. Now, if it is 13%, I'm so happy because now I'm making 3% more, which means there is no risk here. There is no risk here. The risk is here. Similarly, likewise, there is no risk here. There is no risk here, but there is a risk here. So please understand this issue. So this is what we call refinancing risk. If we reverse it, we call it reinvestment risk, which means I want to reinvest my assets and hopefully my money, and hopefully I will find a borrower, or the market will allow me to give in 13 or 12. If the interest rates goes down, it's a problem. Here, if the interest rates goes up, is a problem. Anyways, this is reinvestment risk, and this is refinancing risk. I want to take this one and make it in a table, which means if you understand the concept, we will be just very, we can talk about it very easy. Now, look at this. This is the situation. This is, let me just, this is the current situation. Here is the current situation, which means I have interest income of 100 million and I have interest expenses. I have 1 million, the loan is 100 million, which is the same thing. All of this is the same. 1 million, 100 million, 100 million. This is for the second, for year one. This is for year one, no problem. Which means in year one, I got, as you can see, I got, in year one, I get 2,000, 2 million actually, and I'm happy with that. Now, what would happen in the second year? In the second year, we are talking now about the deposit. We are talking about the deposit, this case for the deposit, which is the refinancing risk. Now, the second year, it could be drop. And in this case, as you can see, I will make 3,000, which means now I will pay only 9 million and receive 12 million. I get 3 million. While in the first year, I used to have 2 million. So is there a difference between that? Because I'm looking for the change in the net interest income. The change in the net interest income is green. I'm happy. Let's go to case 2. This is all in year 2. This is all in year 2. Year 2, the case 2, because I have 3 cases, either 9 or 10 or 11. So because this is fixed, 12%, 12%, 12%. The loan is for 2 years. It's just the deposit doesn't change. So when it changes to 10%, actually no difference for me, no difference, because I will take, this is what I will get. I used to get for the first 12,000 to 2 million. So the impact is 0. I'm indifferent. Now in the third case, I'm only getting now 1 million. I used to get 2 million. There is a drop in my net interest income of 1 million, which means the change in net interest income is 1 million. This is my risk, which I call it refinancing risk. Now let's talk about case 2, which is actually similar of what we say. So in case 1, for example, as I told you, my risk is here. My risk is actually in this place, is in this area, in this box. It's not here, it's not here. So you can see all of this can cover, it's only this box, okay, which shows. Anyways, I don't think it's a difficult issue to understand. It's very simple, it's very straightforward. Let's go and do the same thing here, and let's look at here. So this is the first year, as I told you, I'm getting 2,000. But now what is fixed is actually my deposit. Now I'm having a deposit for 2 years and a loan for 1 year. So deposit I will pay 10% the first year, 10% the second year under the 3 cases. I always pay 2% in the second year because it's a fixed for 2 years. The loan, the problem when the loan finish in the first year, it can be 2% to 12%, which means there is no problem here. There is no impact. Or it could be 13%, which means in this case, I used to have the interest income will be 30,000, and I still pay 10,000, which is I make 2,000 difference, which means 3,000. I used to make only 2,000. Now I have, as you can see, 1,000 green. I'm happy, even happier than the first year. Here is the problem where the loans is only now paying 11%. So I get 11 million. I pay for the second year is, this is 100. I get 11 million interest. I pay 10 million. So in this case, I am getting only 1 million. So the difference, I used to have 2 billion. So the difference is 1, and this is what we call reinvestment risk. Having said that, I think if we know it, this is usually a very important issue to know it. It's very straightforward, but it's easy. Now, how to measure it? This is how it comes. This is how the interest rate, as I told you, when we measure any risk, we want to know what is it and how does it come, like what we show you. We have the investment risk and the financing risk. But then to measure it, we have 2 models. One model, and this is what we're actually going to do for the rest of those slides. One called the pricing model, and the other one called the duration model. We will start with the pricing model. So the pricing model, the problem with the repricing model, it measures only the impact on net interest income. It takes care of that one. So when the level of interest rate raises or falls over a particular period of time, net interest income can change, and the repricing model can measure how much that. So let's look at the repricing model. So the repricing model, we have to introduce ourselves to one issue called risk-sensitive asset and another issue called risk-sensitive liabilities. And we get what we call the dollar gap. When we get the dollar gap, we multiply that dollar gap times the change, with the interest change in the interest rate. Then this is what we will get the change in the net interest income. So if you calculate this right, you don't have to worry about this. Just take the gap, interest rate increases, make it plus, interest rate decreases, make it plus. So a drop in the interest rate, which you will make of 1%, you will make -1. An increase in the interest rate with 1%, you will make this +1. It's either plus or minus. You will see what you can, and then plus or minus, as I told you, and then the gap is here. So the issue is calculating the gap. The problem now is what is risk-sensitive asset and what risk-sensitive liabilities. So to define the model, which is this model, to define it, we are saying risk-sensitive asset, RSA is risk-sensitive assets, RSL is risk-sensitive liabilities, and this is the dollar gap, and this is the definition of the model. Now let's see what is the examples of risk-sensitive rate-sensitive assets. When we have short-term loans, when we have T-notes, this is, look, anything that has a floating rate, which means changes over the year or have a floating rate, all of those products, short-term loans, T-notes, floating rates, all of those actually floating rate loans we have, all of those is rate sensitive. which means when the interest goes up or down, they will change. So let's take it a rule of thumb. When we have short-term loans, anything short-term, usually it is rate sensitive. And sometimes, unless I tell you it's fixed. So the question is, will or can this asset have its interest rate change within a specific time? If the answer is yes, it's rate sensitive. If it is no, not rate sensitive. Fine. What if I have, later on, I will show you, if I have a loan that will end in 2 years and it is fixed, and I'm trying to calculate those 2 years risk sensitive dollar gap. Now, if I put this in a pocket or in horizon, when it matures, then it becomes risk sensitive asset or liability, because when it matures means ends. When it ends, we will have a new one and we will have a new one with a new rate. So the question here, something to add, if the asset is maturing to be repaid, then it's considered risk sensitive asset since it will be reinvested in the new interest rates and therefore becomes part of the RS risk sensitive asset packets. Let's see this one. So this is just another, what is example of risk sensitive liabilities, term deposits, bank acceptance, negotiable certificate of deposits. All of this, as you can see, money market products, and they are less than 1 year. And they are, term deposit can take more than 1 year because term deposit actually are rate sensitive. They have floating rates. And then we have the banker acceptance. This is less than 1 year, short term, and this is short term, and all of those money market. Now, the question to ask is, will or can this liability have its interest change? Same thing. I told you if it is yes, rate sensitive, no, not rate sensitive. So note, if the liability is maturing, then in this case, it will be within the rate sensitive because you have to refinance it. Let me show you this. Okay, so now we want to measure the changes in the net interest income using the repricing model. Now, you have to classify the risk sensitive asset because this is what's happening. If you go to the bank, this, I mean, to get to calculate the interest rate risk in a bank, and they give you all the loans, maybe you need 6 months as a team to take each loan, especially if you have so many loans. I mean, it depends. If the data is there, okay, but if you are starting from scratch, of course, you have to take care of that. And then this database of risk sensitive asset and risk sensitive liabilities, the bank keep updating. So you know the numbers. And if you have a feeling that the interest rate will change in the market because of the overnight rate is changing, for example, the government is trying to decrease or increase the rates, then in this case, you will have to look at those issues and calculate the interest rate risk in case there will be a change. Now, what they do in the banks, and this is what the US do, the US Federal Reserve requires US commercial banks to report repricing gaps. Same in Australia. And they think same in this country, but I know in Australia, they report it, and they will show you now. Here, because the regulation, keep going, and I mean, the central bank keep asking so many different reports, especially for credit risk and all these issues. But the interest rate risk is one of the requirements. So in the US, for example, they ask commercial banks to report repricing gaps for assets and liabilities. How did they do it? They told you divide your assets and liabilities to buckets, 2 classes. Something that mature in 1 day, from 1 day to 3 months, from 3 months to 6 months. So you will take all those loans that mature in 1 month, put it. That will mature now has nothing with sensitivity, whether it is short term or long term. Just take now the maturity horizons. They take the maturity horizons because when the assets or liabilities mature, in this case, you have to renew it. For example, if you take the liabilities and the asset that matures in one day to 3 months, so if they are equal and zero, there is no risk. But if the liabilities higher than the assets and the interest rate is increases, then there is a gap and there is losses. I will show you here. So we have 1 to 3 months, 3 months to 6 months, 6 months to 12 months, 1 year to 5 years, and 5 years. Look how the table looks. This is, I just reflected the table. So this is the risk sensitive assets. Actually, this is the horizon and risk sensitive liabilities. This is the assets and the liabilities. And we get here, the difference between this and this is 25. Just this minus this. This is 10 minus 40 equals 30. And then we continue like this. As you can see, if you add them up, this is by, it's zero. Just by accident, it's zero, okay? Now, if the average interest rate rises by 1% over the next 3 months, which is, I'm talking about this one. In this one, what would happen to me in this horizon is my assets actually is less than my liabilities. This will mature in 3 months, this will mature in 3 months, which means now I have to look, this risk sensitive liabilities, 40 million or 40,000 or whatever will go out of my assets, of my liabilities, which means now I have minus 30, which means I have to, now the liabilities is higher than my assets, and I will be subject to what? To what we call refinancing risk, because 40 will leave my liabilities. Maybe their loans in other buckets or whatever, but 40 will leave. Only 10 will live here, which means here I will be paid for 10, and I will be receiving 10 and paying 40. Now I have to borrow the difference 30. If the interest rate is going up, it's not a good case, because I have to borrow 30 now with the new rate. And this is what's happening. If you look at this horizon, this is coming from what? From what we call refinancing risk. For you just according to the repricing model, you just calculate it. So if the average interest rate rises by 1% over the next 3 months, then the changes in 1 day to 3 months is minus 30 times 0.1, 300,000. This is all. This is the change in the net interest income. Now, we have something else called, this is case 1, which is maturity buckets. Case 2, which is the cumulative gap. Now, the cumulative gap, is different because you have to calculate, you have to get the gap, and then you have to get the cumulative of the gaps. So here, for example, 25, then this is the same numbers I get from the last slide. This is 30, so you have to decrease this from this. Now you are accumulating of 1 day to 3 months is actually minus 5. Cumulative 3 to 6 months, from 1 day to 6 months, is actually minus 5, minus 30, minus 35. From up to 1 year, you will find it minus 65, because you will add all of those, okay? And then so you can add this 65 minus 60, so minus 5. Anyways, now if the interest rate increases by 1 and you want to get the pricing within 1 year, look, within 1 year, which is all of those up to here, which is the gap of minus 65. Now the risk of the cumulative gaps, the risk of the cumulative of 1 year, I can ask you for 3 months, for 6 months, So it's actually minus 65 times 1 minus 0. This is the increase. It's 650,000 for 1 year. If we are talking about cumulative. I told you before that they have what we call the Westpac and all those banks. For example, this Westpac, one of the big four in Australia. And what they do, they report. And this is actually one of their calculation from 94 to the year 2008. And you can see they calculate the assets, liabilities, and actually the 1 year gap. And then this is, you don't have to worry about this column. They calculate the gap over the total assets, which is you can do it. Banks use this as type of indicators, but actually we are only interested to get to this area. This area. Okay. It looks like we are done with the repricing model. So what do we do with the pricing model? Is it good? Yes, it provides information. And it's simple. It's very simple as compared to the duration model, which I explained it in a little time. Now, the weaknesses of this is its market value effect. It doesn't take into consideration the cash flow. And it makes what we call over aggregation. And also it misses some things, run-ups. And for sure, it ignores the off-balance sheet effect, which I already explained it before. Let me go over this one by one. What do we mean by market value? Interest rate changes can adversely affect the market value of assets and liabilities. And that's the net worth, which means now when we look at the repricing model, we are only concerned with the financial statement. Do we talk about the impact on capital, which I talked about it here? No, I'm not talking about this area. This area is completely ignored. I'm only talking about the net interest income. This is what the pricing model. This is one, it's difficulty. So they don't talk about the impact on the net worth. They only talk about the impact of the net interest income. And this is actually one of the problems. Now, what is the other thing? So it's partially measures of interest income. So as such, the repricing model is only a partial measure of interest rate risk, which is takes care only of net interest income, or the changes in net interest income. Okay. The second thing is they say over aggregation. Look, when you look at the packets, for example, this packet is from week 1, from month 1 to 6. Actually, we assume we are saying, oh, all of those, for example, you are calculating in the bank, the ones within this bucket is actually 0 according to this, because you have in week 1 there is no, week 2 there is nothing, there is no gaps here. Look like there are 0 gaps. Here there is 1 gap, which means plus 50. Year of month 4 there is another gap, is 50. But then month 5 is minus 50. 6 months is minus 50. If you look at them, it looks like this one actually 0 gap. While actually inside, because you have 2 months of minus 50 and 2 months of over 50, we are coming back to risk-sensitive asset minus risk-sensitive liability of 6 months. Gap is 0. While actually during the months, if there is a changes, because of this horizon gaps, maturity horizons, it doesn't take into considerations what's happening in the months. This is what we call over aggregation, which means they don't look, I am here, have a positive gap, have a positive gap, negative gap, negative gap. If you add them all up, I am 0 gap, which is actually does not reflect the facts. Now the runoffs. The runoffs means, which is problem number 3, when we have payments from the during the time, we don't take care of that. That can't be, because when there is a payment of a loan that is for 3 years, I have a loan of 3 years. Now this loan for 3 years, when I go according to the repricing model, it is, I will put it under 3 years. But actually this loan is a car loan, for example, which means there is payment every month. No, I said, okay, I will take the loan for 3 years and I put it under the 3 years horizon. While actually there is payments is coming during the 3 years, maybe in annual basis, semi-annual basis, monthly basis. So actually it's not considering that cash flow. That cash flow is taken and also invested again. And we didn't see it because, and this is what we called, there is the runoffs. So this is also the one we take it and invest it again, is it could be rate sensitive. So this runoff component is a rate sensitive, which means that the periodic cash flows of interest and principal amortization payments on long-term assets that can be reinvested at market rates. This, they don't take it to consideration. They just take the loan. It's 20 years or it's 5 years or it's 3 years. What even happening inside, it doesn't take care of that. The third thing, which is the off-balance sheet effect, which is the repricing model generally include only the assets and liabilities listed in the balance sheet. Changes in the interest rate will also affect cash flows of so many off-balance sheet issues. As I told you before, it can change all those derivative contracts. They don't take care of it. And then such cash flows from off-balance sheet activities are ignored by the simple pricing model. So as you can see, all of those problems with the repricing model, and it's a little bit not strong, but very simple. Okay, we go now to the duration. Now duration is a little bit our friend. So the duration take care of that. So the weighted average of time to maturity of series of cash flows, this is what duration is, using the relative present value of the cash flow as weights. Now you will say, I didn't really get it. I say yes. From this wording, you can or you cannot get it, but they are talking about the cash flows, which is one of the problem of the repricing model. They have to take care of that. And I will show you the calculation now. So at the duration takes to considerations the assets or liability maturity, as well as the timing of the cash flow. So this, because now I need to put the asset and liability in different maturities. If it is a loan of 3 years, I will put it a loan of 3 years. But actually, if there is a cash flow coming, it's not 3 years. It will be less than 3 years. So it will take the maturity of 3 years, but the model was constructed in a way that it will take a cash flow and decrease the timing. Also, the loan shows 3 years, but when you see the maturity, the duration model will take it less than 3 years if there is cash coming through the time. So this is the formula actually. Don't worry about this formula. This is just the numerator is the total time weighted present values, and the denominator is the total present values. Let me show you this example. If I have a loan of 30,000, this is the loan, my friends. This is very important to understand the duration model. It's very important. So this is the loan of 3 years of 3,000, and it's for 3 years. So according to the repricing model, I will put this loan as an asset under the 3 years horizon. Under the duration model, they say no. You have to take the payments, which is year 1, year 2, year 3, discount it. This is the discount factor of year 1, year 2, year 3. And this is the cash flow minus the discounting factor, which make it 925 for year 1. This is the present value of the first payment, present value of the second payment, the present value of the third payment. Add them up. This is the assumption of all present values of T. which is this one. Then I have to multiply this by the timing, which is time 1. Here will be times 1. Here will be times 2. And then bring it to here. So 9,2, this is times 2, 70,000. This is times 3, which is 23,000. So you will make here times 2. For example, if you want to know, this is but just times 2 times 3, and you add them up and you divide this by this. So you divided the summation of those cash flows times the discount factor times T, divided by the cash flow times divided by the discount factor. Now somebody will say, sir, do you have a proof? Do you have the proof for this formula? No, I don't have it, and you don't have to worry about it. It's just, it was developed like this, so it takes into consideration the cash flow. Now this loan, who it was 3 years down, how much is it according to the calculation? 1.95 years. Which means now, if you were putting it before, according to the pricing model, to 3 years, now this is just to calculate what we call the horizon. So this loan will be within from the year 1 to year 2, for example, or in the 2 years horizon, not in the 3 years. Now this is the explanation of the model. If you come here, you will find the ratio model to finish it, because the ratio model at the end, I want to calculate the change in the equity. So I have to take this formula to get the duration of the assets. And now I calculated the duration of the assets, right? I will do all the durations of the assets. And I will have to do the same thing for the duration of the liabilities. I have the duration of the assets and the liabilities. I can now use this formula. So this is the to calculate the durations of the assets and liabilities. This is step 1. Step 2, I have to calculate, if I have the assets and liabilities, I can calculate now the change in equity, which is the impact on the balance sheet. So the change in asset, I can calculate the change in equity assets and the change in liabilities if I like. But if you look at this example, if we have a duration of asset of 5 years, calculated through this table and this formula I showed you before, and duration of liabilities of 3 years, now I can calculate actually the change, and the interest rate increased, change by 1%, increases. Then I can calculate this formula, which I showed you before. The change in equity is duration of asset minus K, which is K is the leverage, which means how much is the assets to the liabilities. So here, for example, I have the assets 100, the liability 90, which means the leverage is 90 over 100, okay? Which means liability over assets. So as you can see here now, duration of assets minus the leverage times the duration of liability times the total assets times the change of the interest rate over 1 plus the interest rate. If I take these numbers, the balance sheet, so the duration of asset is 5 coming from here, minus the leverage, which is 90 over 100, 90, times 3, which is the duration of the liabilities, times 100, which is the total assets, times the change in interest over 1 of the change of interest, 1.1. So the drop is actually 2.9. The drop is 2.9 in my assets, in my equities. This is the drop of the my equities. So this equity now is not 10, but actually 10 minus of this one. If I can write it here. Now it's the drop in my equity. Now, if I told you what is my equity, you will say my equity is actually, it's actually 10 minus 2.09. Which is actually 791 or whatever, instead of 10. So the increase in the interest rate, which is logic, the increase in the interest rate has actually decreased equity because there is the duration of the assets is higher than the duration of the liabilities. Look, the duration of the assets is higher than the duration of liabilities. So the impact on the balance sheet, there will be a decrease in the assets, decrease in liabilities, but actually the impact is, so the impact will be minus on the equities. We will talk about this in the workshop. We will talk about this also. I didn't have problem in the tutorial about the durations, nothing about durations. I save it for the workshop. Thank you very much. Let me stop now this one. I wish you a good day. Thank you very much. And we'll see you in the next, we'll talk to you in the next recording. Bye-bye.